Welcome back to Grown Quality. My name is Elian, and today we will be taking a look at Shopify. Now, Shopify hasn't really reacted favorable to its last earnings report, so we are going to dive in to see, well, what is this company all about? Does it make sense that it's sold off as bad, or is it a real growth opportunity that's now become a lot cheaper? Now, I have to give some side note that we are currently having some storm here. So if you hear some thunder going on or hear the rain, I apologize in advance, but it's something I will have to deal with in this video. Now, let's dive straight into it and start by discussing the growth because, well, the growth is what Shopify mostly is about. So if we look at the revenues, we can see that over a 10-year period, they have compounded their revenues at about a 64% annual rate. That's incredible growth. I cannot stress this enough how impressive this is. This company is now worth over $70 billion. dollars. It's come down a lot even from the COVID bubble, but having it compound at such a pace over the last 10-year period is really impressive. Now, if we look at close years, so over the last 5 years, it's 45%, and over the last 2 years, it's 23%. But that's still a very impressive number for a company this size. Now, in its last earnings release, they reported that they grew earnings by 23%, just in line with that 2 year average. But when we took out the adjustments, or when we adjusted for the logistics business that they no longer have, then revenues were up 29%. So that is very impressive. That's almost 30% growth at these levels. And this is annual, but still, we will be looking at the quarterly number in a minute. Now, EPS is kind of a different picture. This company invests a lot in growth still, and of course, you also need to in order to have these growth rates. But the EPS is somewhat unstable. So, having said that, we're gonna look at their income statement. Now, this is the income statement from their annual report. We will also be looking at their income statement from Q1 24. But from their income statement from last year, from the full fiscal year 2023, we can see that subscription solutions are up a bit and merchant solutions are up a bit more. Now, what the difference is here, I will explain in a minute. But we are going to continue quickly because we can also see that the merchant solutions cost of revenue, well, they increased also quite a bit. So that might not be very positive, but it's a very good earnings or very good income statement. If we look at the operating expenses, we can see that sales and marketing is almost flat. Research and development, it's up a bit, but that's to be expected. We can see general and administrative, that's down. That's very good. And we can see that the transaction and loan losses, they are up a bit. Now, they did take an impairment on sales of Shopify logistics business, and that was about 1.34 billion dollars. That's quite a bit impairment. The logistics business, I don't know. They have had it for a year, and then they got rid of it. I understand it because logistics is typically a low margin business, and that's not what Shopify does. Although Shopify said that they had it in order to support merchants with having faster deliveries. Now, they did convert it to a stake in Flexport. They got a 13%, I believe, 13% stake in Flexport, but they didn't get any cash back. So I'm not all too sure about that transaction, but it's a good thing that they got rid of it at least, because now they have the high margin, business that they had, they have it now back. They are a capital light business, as you will see in a minute, and that's the way they should be. They shouldn't go after logistics, in my opinion. Okay. So anyway, we can see here that they had a net income per share of 10 cents in fiscal 2023 compared to a loss of $2.73 in the prior year. Now, they did a lot of stuff because they also fired about a quarter of the people that were working there. But if we look at the balance sheet, we can see that cash has gone down a bit, marketable securities has gone up a bit, trade and other receivables basically flat. They increased their loans on their books, and some other current assets increased also. When we look at property and equipment, this has gone down a lot. Operating lease down a lot. Intangible assets down a lot. This is probably mostly due to that logistics business that they got rid of. But all in all, when we look at the bottom line, we can see that total shareholders' equity has gone up a bit. Okay, so that's good. But then if we look at the income statement of Q1 23, or Q1 24, I should say, excuse me, we can see that the subscription solutions has gone up quite a bit, and the merchant solutions as well. Now, I'm not going to bore you again with all the details, but if we look at the bottom, we can see a slight loss on net income per share uh, level compared to a slight profit in last year. What's more of a concern to me is what their revenue streams are, because we saw subscription and merchant solution revenues, and the subscription revenues are basically the platform. So when you go to Shopify and you build your website there, you get a subscription in order to have all the stuff you want. And then the merchant solutions are all the added stuff that you put on there. So here we have a sheet with some of them, but the most notable one is the Shop Pay. Shop Pay basically lets you pay for your stuff through the uh, Shopify payment solutions, kind of like PayPal. It's my closest comparison. And if we look at it, we can also see that the payments and processing is the most important part of this business. We can see that it's growing the fastest, and as a percentage of revenue for what they estimated in 2023, because this slide is from the investor presentation that was held in December, it's also the most important part, as they figured it to be around 60% of their payments. Now, a good thing is that when merchants have Shopify Pay on their website, on average, they are set to convert almost 10% more. So using Shop Pay is a really good way for merchant to get more sales in. And we can see that it's also kind of a good way for Shopify to earn some revenues. So I'd say that's win-win. It's just really important for them to keep growing this. But they can do so by adding more and more merchants, which they do. And I will show you later in this video by what extent, because it's truly impressive. But for now, let's focus on my bull argument, my bear argument, and my conclusion as we go through this. And for my bull argument, it's the increasing TAM, the increasing total addressable market, because that's quite something that Shopify is able to pull off here. Because if we look at this slide, we can see that in 2015 they had about a $46 billion total addressable market. 5 years later, this grew to 153 billion. And 3 years after that, so last year, they were at almost $850 billion of total addressable markets. Now, they did so by just adding and adding and adding all kinds of additional products to their offering. And this is also what they say: more products, more geographies, more merchant sizes. They are going up market with the merchants they are pulling in. And some of the notable ones are Shopify. Well, yeah, I hope they use their own product. But Gymshark is a very popular one that they have on their platform. And that's by far not their largest. And they see more and more big companies using Shopify. Now, for my bear argument, I'm going to give you this slide. The free cash flow, it's inconsistent. EBITDA is inconsistent. Net income, it's inconsistent. And this is probably to do with all kinds of investments. And they want to focus on profits. They have said this during their earnings calls, during the investor day. They want to forget 2021 with growth at all costs. They want to streamline the business. They have fired about, well, almost a quarter of their staff has gone or has left the company last year. They want to be flatter, leaner, move faster. Basically what all companies did, but they took it to an extreme. And I think the solution that they have for this is quite good. Be leaner, have less costs. But the net income is truly inconsistent. And that's a bit worrying because you want to see a nice uptrend going on each year, each quarter a bit more. And that's what's lacking here. Okay, so then we go to my conclusion, and I very much like Shopify. Shopify holds about 10% of US e commerce market share, but we have to say with this that it's excluding offline merchant sales. But 10% US e commerce market share is really impressive, and it's not just US, it's also Western Europe, where they hold about 6% of the e commerce market share. This was through Shopify internal data, but 6% of Western Europe is also very important because you don't want to have Shopify being dependent on the US if you want to have them continually grow and grow and grow. I mean, Shopify is worth 70 billion, a bit more. So they need some diverse geography and be big in other places than only the US. And as we can see here, they are. Now, like I already mentioned, ShopPay is the number one checkout method in the Shopify merchant stores, and it provides the merchants with 10% higher conversion on average versus other wallets. Now, they also say that having the ShopPay purple icon on your website even increases sales. So that's quite fun to hear, but yeah, if they have it just on the website and not use it, no revenues for Shopify. So yeah, okay, they have the subscription. Now, this is the slide I really wanted to show you because when we talk about the growth, we have to put it in context. And when we say they take market share, we mean that they take mid market share by 43-1. So for every one merchant that is leaving Shopify, they gain 43. For every large Shopify merchant that leaves the platform, they gain 26. And well, guess what it means with enterprise? For every enterprise customer that leaves Shopify, they gain 38. Now, it's important to say that mid-market, large account, and enterprise segment merchants are defined as generating 2 to 20 million for the mid-cap, 20 to 125 million for the large cap, and over 125 million in annual gross merchandise volume. So the enterprise level is quite big. And seeing Shopify go after these merchants is really quite good because as we saw that the ShopPay is driving the most revenues for the company, having these enterprises on the platform is not just important for the subscription revenues, but more so for the ShopPay revenues because that's where they make most of their money, that's where they earn the most income, and having those large customers just accelerates the use of the ShopPay button. And that's really good. That's what I really like. Now, what I don't really like is the valuations and the inconsistent incomes because the valuation is very high. It's extremely high. They trade at about a 1.5% free cash flow yield. So that's really expensive, but the company always has. So is it a good time to buy now? I don't know. I will give more details on this in my analysis that I have written down on my website. You can find the link to my website in the description below. It will be the top link I have posted there. And with that being said, I hope you have enjoyed that video. I hope to see you next week. Bye.